Good morning, you're watching Business World Live. I'm Jes Delos Santos. It's the start of a new trading day, but first, let's go straight to our top story. S&P Global Ratings warns that a new surge in COVID-19 infections could further delay the country's economic recovery. In a report, the Debt Watcher said that if recovery is delayed by 6 months, domestic output will only return to pre-pandemic levels by May next year. S&P's forecast for 2021 GDP growth remains at 9.6%, faster than the government's target of 6.5 to 7.5%. The baseline estimate assumes that output level will return to pre-pandemic levels by December 2021, which is seen as a slower recovery pace compared with ASEAN peers. S&P's report comes out just as President Duterte thumbed down a proposal to put the entire country under modified general community quarantine. Malacanang said the president has given higher premium to public health and safety, saying the country will not be placed under MGCQ unless there is a rollout of vaccines. Meanwhile, in a separate report, S&P said the financial buffers of some Philippine banks may not be able to absorb a fast deterioration in asset quality. It noted that the banking industry is likely to experience a long road to recovery as non-performing loan ratio is seen to hit 6% this year, up from 3.6% last year. S&P said NPLs could spike in the first quarter as loan moratorium and fiscal support end. NPLs could then peak in the second quarter. All right, with no clarity in sight yet when it comes to vaccine delivery, let alone rollout, the index stumbled yesterday to 6,800. Let's see if the slide continues after the president decided to hold off on transitioning the entire country to the least restrictive quarantine status. As you can see right here, local shares here continuing its slide here, tanking 0.4%. It's now at 6,784.05. That pretty much joins the sell-off seen across Asia, with investors weighing faster growth projections as well as inflation that drove up commodities and bond yields. Back to our source. Let's have a quick check of our leaders and laggards for the day. Let me just refresh this very quickly. As you can see here, a number of stocks, in fact, enjoying some gains already here at the start of the trading day. The likes of Megaroll, which is up 1 3/10%. The property player is our leader so far this day. A number of property players also on the upside here. The likes of Robinson's Land here, which is so far up by over 8%. PLDT, as you can see as well, also in the green, 0.6%. We're going to give you more details and some developments on the telco giant, as well as their partnership with Dito Telecommunity. Also, you have here, however, on the downside here, SM Investments is still the country's, at least PSEI's laggard here, down 1 2/10%. Of course, SM as well as Ayala Corporation have so far in the past few days been leading declines in the index, with both stocks weighing heavily on daily losses. Ayala Corporation, as you can see here, also still in the red, edging lower, close to 0.5%. But a couple of stocks to be watching out for today, as I've mentioned earlier. Let's start off with Dito Telecommunity. The telco player speed and coverage commitments have been found compliant by the National Telecommunications Commission, with population coverage above threshold at 37.48%, while broadband speed far exceeds minimum requirements at 85.9 Mbps and 507.5 Mbps for 4G and 5G respectively. But don't get your hopes up just yet. Dito says actual speeds may differ once it rolls out, but even before they launch, Dito already inking partnership with telco giant PLDT. They have signed an interconnection deal as they seek to set up a transmission facility to serve as point of interconnection for their subscribers. PLDT is set to establish and manage the facility. The hub is meant to deliver inter-carrier requirements of Dito, which is seen to also benefit fixed and wireless users of both telcos. That's slated to be finished by the end of next month, just in time for Dito's launch, rather, looking at how both stocks are performing here. You'd see here PLDT is actually up by 0.8% now, price at 1,317, make that 1,318. Dito, however, as you can see, also making gains here, as represented by the second chart here in the orange line here. Dito now priced at 18 pesos and 98 centavos a piece. Now, lastly, let's have a look at JG Summit. The Gokongwei firm has taken a stake in South African digital bank Time. That's estimated to be at 5.3 billion pesos. The investment made together with Apis Partners and African Rainbow Capital. The funding will help Time Bank grow in South Africa, which has so far gained 2.8 million customers. Time is considered to be the fastest growing digital bank in emerging markets. JG Summit President Lance Gokongwei says the venture will help accelerate the conglomerate's foray into disruptive digital play, as well as a possibility of bringing Time's technology to the country. Looking at how JG Summit is performing so far, they are in the green here, up by close to 0.25%, now at 63 pesos and 25 centavos a share. All right, we circle back to our top story with the president rejecting calls for looser restrictions pending vaccine rollout. How might that impact hopes of a recovery? Let's get insights from ING Bank Manila's Senior Economist Niki Mapa. Good morning, Sir Niki.
Thanks for having me on the show.
All right, sir. To kick things off, of course, the president holding off on plans to transition to MGCQ for now. Does this in any way dash chances of recovering from this pandemic-induced recession?
Well, I think regardless of the level of restrictions that we have, if it's MGCQ or GCQ, I think the damage, the scarring effects from this pandemic have already begun to show. So yeah, I'm of the opinion that even if you do relax to MGCQ, because of the, I guess the labor market conditions right now, even if you open the doors, you let people out, the mere fact that people have lost their jobs, unemployment's at 8.7% right now. That's very far from the pre-pandemic average of 5.5%. Even if people are allowed to get out, I doubt we're going to see the same type of consumption that we saw in 2019. Authorities are of the opinion that, you know, if we open the doors, we release the floodgates, and we'll have a whole lot of spending. However, you know, just given all the different conditions we're seeing out there, high unemployment, poor consumer confidence, I'm still not expecting a sharp bounce back in spending just yet. And, you know, likewise, the economy will continue to struggle in the near term.
Okay, good that you pointed out about the labor market. That has seen an improvement, at least in the latter part of 2020. Do we see that improving further?
I think NEDA themselves have said that we're likely to see this type of elevated unemployment for at least 2 more years. I think the number they pointed out was 8 to 9% for the next 2 years. So we're likely to see these conditions play out for the next few quarters. And if we have this type of unemployment, 8.7% unemployment translates to 4.5 million Filipinos without a job. So no job, no income, no spending. At the same time, you have 420,000 OFWs sent home, repatriated after losing their jobs abroad. That's $500 a month times 420,000 OFWs. That type of purchasing power will be absent for the next couple of months, or until we can get them redeployed. So not a lot of punch in that consumption angle for now. And as you know, consumption is the largest portion of the economy, and with that missing, we can't expect a sharp bounce back in growth in the near term.
What then do you think would revive consumer confidence? How much of it is really latched on a vaccine rollout?
Yeah, I mean, you said it right there. The only way that we gain consumer confidence is if we have a vaccine that we can trust. Acting Secretary Carl Chua is of the opinion that if you open the economy, people automatically gain consumer confidence. However, I think it really latches on the vaccine rollout. If we can get a vaccine in the near term, that's the only thing that I feel will convince people to go out and start spending again. Without that, we're still likely to see people huddled in their homes, And for good reason. I mean, catching this virus is likely very detrimental to one's health and even fatal. So we can't blame consumers for staying at home or opting to not go out to the malls. The virus is still pretty much at large, and people will adjust.
And with no clarity yet when it comes to vaccine rollout, do you see consumer confidence still remaining low, at least in the next few quarters?
Yeah, I think this is a number as it's shown on the screen. The BSP's Consumer Expectations Index that should stay quite low. Very far from you see the pre-pandemic average of 1.3 index points. We're now at negative 47.9. That's still the far path before we get back to the pre-pandemic levels. Vaccines will help. The job market will help as well. So yeah, I think that this all sort of hinges on getting the vaccine, getting people confident in going out again. But until we get those vaccines, yeah, I don't think we can see this bouncing back anytime soon.
I know you mentioned this earlier that it's pretty much a non-factor, but how long can the economy accommodate strict quarantine restrictions?
Well, it just depends on who you're listening to. I mean, the economists, the officials, the economic bloc is still pushing for relaxing the restrictions in the name of economic recovery. Health officials and some of the ATFA, maybe the LGUs are saying no, keep them inside because we cannot. We cannot withstand a spike in cases. We can continue to be in this, but I think it just depends which you highlight more. If it's keeping people healthy or getting the economy up and running. The answer to all of this, to sort of tie these two together, is get the vaccine. It answers both questions of getting consumer confidence as well as ensuring that people can stay safe and healthy. So the vaccine rollout is paramount at this stage.
Okay, but at the same time, with the president closing doors on a probable shift to MGCQ, this in any way fuel the need for another stimulus package, to be exact, a Biennium 3.
Yeah, I mean, analysts from here and across the globe are saying, this is one of the ways that you can augment the current slowdown. I think we know that the economy lost ₱1 trillion worth of economic activity due to the lockdowns. And all the sectors are out. Consumption's down. Investments are likely not going to return anytime soon. So the only sector that has the strength, the wherewithal, and I guess the ability to really, come in and do a lot of spending is the government. Even if we're hearing some very nice calls for a well-designed package by Anihan 3, unfortunately, it doesn't look like the government is supportive of that just yet. But that is the way to jumpstart the economy. We have used several analogies in the past. My current analogy for the state of the economy is that we're a car that's been stuck and we can't get it started. We need a jump start right now. And that has to be the government coming in with a big and forceful stimulus package. All these concerns about not having money, I think those can be allayed given the fact that there's a lot of liquidity in the market right now that's not going anywhere. They can float bonds for the meantime and try to get this economy jump started as soon as possible.
All right, and lastly now, Niki, before I let you go, yesterday's development with the president again holding off on easing restrictions, does this in any way color your growth projections for the year, or is still pretty much set at the moment?
Yeah, my own projections were sort of expecting that GCQ would hold for the full year, given the fact that my assumption for the vaccine rollout will be sometime mid next year. So yeah, with that in mind, if we get the vaccine sooner, then maybe I'll adjust my growth projections to see a faster growth pace. But if the vaccinations aren't here by mid-year or by end next year, then I'm willing to keep my current projections intact.
Okay, just to give our viewers an idea, what's your growth outlook for the country, at least for the year?
Yeah, I mean, so for the next few quarters, we're likely to see some really nice headline-grabbing growth numbers. But these, of course, are base effects after we fell by 16.9% in the second quarter of last year. But after that, after all the base effects wash out, because there's not a lot of momentum in the economy anymore, looking at a moderation of growth, average growth should settle at about 4.7% post base effects. So maybe end of 2021, from there on, we'll average at 4.7%. It's quite a ways from the 8% growth target of the government and very far from the 6.2% average that we had prior to the pandemic. It's still modest and decent growth. However, it's just not what we're used to.
All right. Thank you very much for your time this morning. ING Bank Manila Senior Economist Niki Mapa.
Take care, stay safe.
Here are other headlines we're keeping our eyes on. The Transportation Department says it will soon begin work on 75 more airport projects. The DOTR says it has already completed 121 airport projects, while 114 are well underway, with 75 set to begin soon. These include construction work on the airports in Clark, Calibo, Bacolod, and Catbalogan, among others. Projects that are currently ongoing are the upgrade of airports in Vigan, Basco, Calayan, Virac, and Antique. The agency said all of this is part of its mandate to advance air connectivity and mobility in the country despite the pandemic. The government's fuel marking program yielded almost 193 billion pesos from duties and taxes on fuel products since its launch in September 2019. That's according to the latest data from the Finance Department. Majority of which came from the collections made by the Customs Bureau until February 17 this year. Meanwhile, the BIR generated about 26 billion in excise taxes from December 2019 up to February 11. By region, almost 74% of 14.7 billion liters were marked in Luzon, 21% in Mindanao, and 5% in the Visayas. Diesel accounted for 61% of the total collections, followed by gasoline with 38%. The fuel marking program aims to deter oil smuggling by injecting the products with a special dye to signify tax compliance. Recall that the government started collecting the fuel marking fee in September of 2020 after 1 year of subsidy. The rice tarification law is not working as planned and has not delivered its promises. That's according to a study released by the Federation of Free Farmers. The group claims consumers have paid for more rice, while producers have lost billions of pesos in income 2 years into the law's implementation. The FFF said rice imports totaled 2.12 million metric tons in 2020 against a 3.17 million metric tons in 2019. But despite more imports, retail prices have hardly budged from their 2017 levels. The average price of well-milled rice in 2020 was recorded at 41 pesos and 67 centavos compared to the 42 pesos and 3 centavos in 2017. For the Federation, this proves that rice prices for consumers will not go down just because we allow more imports to come in. That's why the group is now urging the government to step in and ensure that the gains from the RTL are equitably distributed along the rice value chain. And that's a first look into the business day this Tuesday, February 23, 2021. Catch Business World Live for the market close at 3:15 p.m. today. I'm Jes Delos Santos. We are One News.